Hi guys, and welcome back to my channel. Today I'll be sharing why I invested over $12,000 in just one ETF. What? Keeping in mind that my intentions are for long-term investing, I'm going to be explaining why I chose this for my portfolio in my Roth IRA. This is a good one, so you definitely want to stay tuned. As a disclaimer, this only makes up a portion of my portfolio. It's not 100% what I invest in. In addition, I invested into this using dollar cost averaging, which just means I did not dump all $12,000 into this all at the same time. I did it over the course of 2 years. If you're interested in anything that I mentioned, then be sure to check the links down below for more references and resources so that you can read up on more. And the one I invested in is the Vanguard S&P 500 ETF, aka VOO. VOO is one of the biggest index funds that track the S&P 500. So in other words, it means that it tracks the 500 top and biggest companies in the US. So without further ado, let's get into the juicy bits of why I chose this ETF as a major part of my portfolio. Alright, let's just get this video started out with the juicy stuff. Why exactly is VOO strategic, and what do experts have to say about this itself? Because you're probably interested in what exactly does VOO have to offer that's so good. So I'm going to provide you just that right from the start of this video. Let's start with some numbers. For ages, there's been a long-standing debate on whether or not you should go with index funds and passively invest or actively manage your portfolio. More and more evidence is coming out that 95% of financial managers cannot outperform the stock market. So what does this mean? This just means that you can't really beat the S&P 500. And if you do, the chances are very slim. Although short-term results may favor investors who choose to actively manage their portfolio, over the long term, they tend to underperform. Although there is a very slim chance that you may outperform the market or beat the market, it's less strategic in terms of time and energy as opposed to investing in low-cost index funds or ETFs. This sounds incredibly strategic to me because through choosing to passively invest, you're essentially able to beat 95% of people who opt to actively manage their portfolios. Okay, yes, you definitely can make huge gains through actively managing your portfolio and doing your due diligence, but personally for me, my time and resources just don't want to be wasted on that type of effort. Alright, now let's get into what experts have to say about VOO and exactly how it compares to other famous and successful strategies. So I decided to compare VOO to two of the most popular investment strategies out there, Warren Buffett's 90-10 and Ray Dalio's all-weather portfolio. Legendary investor Warren Buffett's 90-10 investment strategy consists of 90% large cap stocks and 10% bonds. And as for Ray Dalio's all-weather portfolio, it consists of a mixture of exposures to limit downside in a bear market. As you can see, over the long term, VOO beats these two investment strategies, proving the power of ETFs. That's not to say that Warren Buffett's or Ray Dalio's strategy is poor, because it's definitely a great investment strategy. Both their strategies outperform VOO during downturns. However, for long-term investing, which is what my intent is, investing in VOO definitely shines because you don't really care about 1 to 2 years of bad performance. Those 1 to 2 bad years won't make a difference in the long run when I'm planning to retire and pull out these investments when I'm age 65. Essentially, the point I'm trying to make here is don't miss the forest for the trees when it comes to this strategy. Warren Buffett is widely known as an expert and almost royalty in the investment industry. If we are to trust anyone, then it might as well be someone like him. And one of the top investment strategies that he relies on is to invest in index funds, aka something like VOO. A major reason why VOO is so great is because of its diversification. VOO gives you exposure to the top 500 public companies in the US. This extent of diversification has time and time again proven to be a successful methodology in investing. Long-term and experienced investors can all agree that ETFs are a great vehicle because they allow you to invest in so many different successful stocks through just one simple holding. Historically, the S&P 500 returns 10% per year over the long horizon. For me, diversification is important for two specific reasons. First, it'll protect you against volatility in the market because it's so diverse, and in addition, it prevents you from making very bad assumptions on how to build out your portfolio, especially when you're starting out. Diversification is definitely a technique you want to implement in your investing strategy because by allocating all of your investments across different financial instruments, categories, and industries, you're going to be able to maximize your returns. Because when all of your investments are spread out across so many different categories, they're all going to react differently to any specific event. So for example, if your entire investment portfolio is based off of one specific industry like airlines, if something were to happen to the airline industry, such as something as big as our global pandemic right now, the entire airline industry would suffer, and thus your entire portfolio would suffer. In short, diversification is great because you're able to reduce your risk overall. The next reason why VOO is such a great ETF is because of its low cost. Now, low cost is pretty self-explanatory. Why would you ever want to pay more for anything? The expense ratio for VOO is extremely low at a 0.03%. Now, when we're looking at expense ratios for stocks, it's so easy to look at a 0.5% to even a 2% being very minuscule, right? I mean, it looks too small to make a difference. In everyday life, this is only going to be a couple cents, whether you're buying a pack of gum or a carton of milk. But the truth is, 1% can amount to be a lot when you're dealing with stocks and investing. A high expense ratio is going to have a huge impact on your profit as an investor, which is all that we care about. We're literally investing our money because we want to see returns. And if these fees are eating up at the returns, then we're basically being a little counterproductive, don't you think? The average expense ratio for most ETFs is 0.44%. So this means that if you're investing $1,000, then the expense that you have to pay would be about $4.40. VOO has an expense ratio of 0.03%, which is drastically less than that. This means for every $1,000, you're only charged a fee of 30 cents. So you're probably wondering, why is VOO so cheap compared to the average cost of ETFs? And that is because VOO is a Vanguard fund. And unlike other investment management companies, Vanguard is not owned by outside stockholders. Therefore, there are no fees owed to outside stockholders, which just means there's more money put into your pockets as investors in Vanguard. Another reason why VOO is so great is because it's beginner friendly and it accommodates the long-term investors of all levels. Now, when you're beginning your investing journey, it's a great idea to start with ETFs. This is true for a number of reasons. As a beginner, if you're not 100% confident in the stocks that you're selecting, or if you lack understanding and trust in your positions, then ETFs are an amazing starting point. This is because as you're learning about stocks and understanding the stock market, you can jumpstart your portfolio through investing in ETFs while being confident that they will hold less risk than investing in individual stocks that you're uncertain about. Furthermore, VOO gives you the ability to passively invest. Rather than constantly dipping in and out of the stock market, consistently researching companies and staying up to date with different trends and industry news, you can invest in VOO to reap the benefits of long-term and steady growth. So there is no such thing as one perfect stock, which is why I'm going to have to mention a couple of downsides of VOO. One major downside of investing in VOO or any type of S&P 500 ETF really is that it's disproportionately weighted toward larger companies. The way that this works is that the S&P 500 uses a weighted market capitalization structure, which favors the larger companies. This allows the top 50 companies by market cap to account for more than half of the index's value. In short, the top 50 companies have an enormous influence over the S&P 500 overall. A great example of this is that even though the economy may be doing poorly due to current world issues, the S&P 500 is still doing great due to the performance of the top tech companies that dominate the S&P 500. As you can see, in this way, things can be quite skewed. Another downside of investing in VOO is that there's no international exposure through investing in the stock. The reason why you want international exposure and to invest outside of the USA is because it provides you more exposure and therefore less risk. Essentially, you have enhanced diversification. Another downside is that with investing, there's always going to be a risk factor to consider. Since VOO is an ETF, it can be highly volatile since 100% of it is invested in stocks. Historically, long-term returns have always been profitable through VOO, but that doesn't guarantee anything because there's always a chance things could take a downturn. As much as we like relying on historical data, past performance is not in any way a guarantee or indicative of future performance. Lastly, this has to be said, but VOO can be a really boring investment choice, especially if you dislike a passive approach to your investments. While some people love to actively manage their portfolio and constantly do their research, VOO is quite passive in the sense that you don't constantly have to be so hands-on in your strategy. Thank you so much for watching this video. Comment down below what your thoughts are on VOO. Also, what stocks do you prefer when it comes to your investment strategies? Let me know down below. Thanks!